Hello and welcome to my video log. On here we look at all kinds of social phenomena and we ask ourselves if government action is helping or if it's actually making things worse. Today's topic: inflation. Have you ever wondered why the prices of all your necessities are going up while your salary stays more or less the same? It's a strange phenomenon, isn't it? Ask yourself, is this a natural process? Would you expect a business over time to use more time and more resources to produce the same product? Or would you expect it to get better at its job, to get more efficient with resources and thus get cheaper? Of course, it makes way more sense for the latter to happen. Production processes should get more efficient over time, and so prices should be falling. But this isn't happening. Why? What if I told you that this process of rising prices is actually a deliberate government policy? Sounds like a conspiracy theory, right? Guess again, it's not even a secret. You see, since John Maynard Keynes wrote his book, The General Theory of Unemployment, Interest and Money, we have these economists that think they are so smart they can kind of steer the economy. And it so happens that these economists are terrified of falling prices, a process which they call deflation. They think that if consumers know that prices are going to fall, they're just going to wait until the prices fall and thus delay their consumption. If consumption is delayed, supposedly the economy will stagnate. This is of course ridiculous. We can prove this by using goods that fall in price faster than inflation can push them up. Electronics, for example. Everyone knows that the iPhone you buy now will be a lot cheaper next year. But still, we don't see many people are willing to wait. For the very simple reason they would rather have the phone now and enjoy it now than wait a full year and save a few bucks. Keynesian economists, however, can't be bothered with those facts. So what they did is they formed a central bank and they gave that bank full control over the money supply. And what basically happens is that the central bank creates money out of thin air. And I'm not making this up. This newly created money they either use to buy government bonds, or they use it to lend to banks at very, very low rates. The banks in turn can then lend out this money to consumers and to private enterprises. Strangely enough, bankers don't complain about this policy which grants them free money. But there's obviously a downside to this. You see, when the money is spent and gets into the economy, there's suddenly more money in the economy. But there are not suddenly more goods available. So we have more money now to buy the same amount of goods. And this will inevitably mean that prices are going to rise. And that is what we call inflation. Now the central banks claim for price stability, but they're actually satisfied when inflation is around 2%. And this doesn't sound like much, but it means that in 30 years the money will have lost half of its value. This inflation process is very hard to save up against, especially with artificially low interest rates. Borrowing, however, is extremely stimulated, since the debt will also lose value. And this is very convenient for big borrowers, namely governments. Now, aside from the fact that this inflation process hurts the poor by making their groceries more expensive, and aside from the fact that it devalues the life savings of hardworking people, and aside from the fact that they stimulate government and consumer debt. These policies create a much bigger problem, namely the business cycle. The business cycle is something I will explain in the next video. This is it for now. If you have any questions, ask them in the comment section below. Don't forget to rate, subscribe, anything. I'll see you in the next video.